Last Thursday, the OBR published a detailed forecast for the UK economy. It made for grim reading. The longest recession for a generation, falling disposable income, and real wage growth which will amount to around 35% less than its pre-crisis trend rate. Amongst the dire economic predictions, the OBR forecast house prices in the UK would fall 9% in 2023 and not recover their current level of around 290,000 until the end of 2027, which could mean at least 4 years without any house price growth. A 10% fall may not seem that much, but given that we currently have inflation of around 10%, the real inflation-adjusted change in prices will be closer to minus 20%. Another interesting feature of the OBR forecast is how much has changed since their earlier forecast in March. You can see that in March, the forecast was only for a brief stagnation before resuming their upward trend. But several months later, this outlook has become much more pessimistic. From this, we might summarize two things. Firstly, economic forecasts are often proved to be inaccurate, or at least need frequent updating. Secondly, a lot has changed in the UK economy and housing market in recent months. Higher inflation, the disastrous mini-budget. In this video, I will look at what has changed in the UK housing market and also answer some viewers' questions and comments from a recent video I made on the UK housing market. And in particular, we'll have a look at whether it is better to wait or not before buying. Firstly, just to recap the basic situation of the UK housing market. Prices have risen 80% since 2009, despite a period of low economic growth and barely any increase in real wages. According to Nationwide, the result is UK house price to income ratios have reached an all-time high of over 7. If we use the ONS measure, the house price to income ratio has reached 9 times. The difference is due to different ways of measuring household earnings. But the main thing is, as we all know, house prices are just very unaffordable. And of course, there is a big difference depending upon geographical location. The ONS show how house price to earnings ratio vary from 13.7 in London to 5.3 in the north. Of course, even within these regions, there can be a big variance in price, but clearly London and the South East are more vulnerable to falling prices. Nevertheless, it wasn't actually these house price to income ratios that caused the OBR to become more pessimistic in the past several months. Basically, back in March, we were forecast only a small rise in interest rates. But since then, high inflation, Ukraine war, disastrous mini-budget, and the OBR now forecast mortgages to rise to 5% and only slowly come down. This fairly modest rise in mortgage rates actually makes a huge difference for mortgage holders. The effective mortgage payments as a share of income will be close to 2008 levels. With interest rates of around 5%, mortgage payments will be just under 45% of take-home pay. Now at these levels, with a cost of living crisis, higher taxes, falling real incomes, some may be unable to afford mortgage payments. But perhaps more importantly, it is a huge disincentive for people to try and buy in the next couple of years. Now here I'd like to answer a common comment from viewers. Why would house prices fall when so many households are very wealthy and own their house outright? It is true that wealth has accumulated in the past decade. Around 36% of homes are now owned outright or with just small mortgage balances. These homeowners will remain largely unaffected by rising interest rates and house price to income ratios. Also, these homeowners are in a position to help their children get on the market. And this is one reason why house price to income ratios have risen in the long term. However, in the short term at least, a key factor in determining house prices is the number of first-time buyers coming onto the market. If the number of buyers fall, then it puts downward pressure on prices. The fact that millions are happy to hold on to their homes doesn't change this. So high interest rates combined with falling real incomes and economic uncertainty mean the number of people wishing to buy a house is falling. And new buyer inquiries have fallen sharply in recent months and are likely to continue falling over the winter. Now, sellers may respond by taking their house off the market, waiting for conditions to improve, although they may have to wait several years. And if they do reduce houses on the market, this will limit price falls. And certainly the number of transactions is likely to fall in 2023. Residential transactions are predicted to fall from around 1.25 million to 1.05 next year. Also, with expectations of falling prices, that's another reason first-time buyers may decide to wait. Now, it is worth stressing that the number of homes owned outright, high levels of wealth, is a factor that will prevent any kind of collapse in prices. For example, if you go back to the early 1990s, a combination of high unemployment and interest rates of 15% did lead to a sharp rise in repossessions, and therefore in the early 90s we had an increase in supply of homes at the same time as falling demand, causing a big fall in prices. I think that in 2023, although economic conditions are grim, the number of repossessions will be limited by a few factors. Firstly, unemployment is not forecast to rise too much, at least compared to previous recessions, because of a shortage of labour in the UK. Also, mortgage criteria have been tightened since the 2008 crash. We don't have lots of subprime mortgages, so we're not going to see a wave of mortgage defaults based on false mortgage lending. And of course, banks are keen to avoid repossession if they can. So although prices are set to fall, we are unlikely to see house price to income ratios return to levels last seen in the mid-1990s. Another common reader's question was, how will rents be affected by falling house prices? And I'd like to do a video on the renting market soon, but in brief, unfortunately the outlook is pretty grim for the rented sector. There's a shortage of properties coming onto the market. This is partly due to a rise in homes let on Airbnb. At the same time, national demand is very strong due to rising population, the unaffordability of houses, and an increase in the number of households. Also, there are certain conditions encouraging buy-to-let investors to sell. The prospect of falling prices, rising capital gains tax, higher interest rates. So all these factors may encourage them to sell. Or many landlords who face higher mortgage payments may try to increase rents to meet their own costs. And given the limited supply, they do have the market power to do this. And you can see there is a strong expectation of rising rents and rising tenant demand. And it's a rise in rents at exactly the worst time for young workers squeezed by the cost of living and falling real wages. Another question is, how will house prices be affected by the recent budget? Well, I think the main thing about the budget was highlighting how grim the economic prospects for the UK are, and of course this will depress housing demand. The OBR were actually more optimistic than the Bank of England. The Bank of England forecast a really deep and long-lasting recession, which will reduce incomes and squeeze housing demand. The only thing is that the Bank of England also forecast interest rates may not rise by as much as the OBR. So if interest rates don't rise as much as feared and banks reduce their mortgage rates, the fall in house prices may be less than the OBR fear. There were some specific measures in the budget which will hit the housing market. Firstly, capital gains on selling second homes will see a reduction in the tax threshold, making it less attractive for buy-to-let investors, which may help reduce house prices in the long term a little bit. Also, the stamp duty threshold will be cut back from 250,000 to to 125,000 after March 2025, and this may encourage some people to bring forward their purchase to avoid the stamp duty. Also, by freezing income tax thresholds in a period of high inflation, more workers will be pulled into the top rate of income tax, which will make it harder for people to save up for a deposit. Now the big question is, should I wait or buy now? My advice is generally that if you are buying a house to live in, don't worry about what may happen to house prices. Don't try to be over clever and hope prices fall a lot. It is worth bearing in mind UK house prices have often defied gravity. In the very long term, the fundamental shortage of housing is probably going to keep them expensive. So given this, why spend money on rent when you can start investing into repaying your mortgage? House prices are almost certainly going to fall next year, but it is also unlikely we will see a Florida-style 2008 crash. Some global markets are much more vulnerable than the UK, and I'd like to look at them in the near future. But the UK is set for a fairly significant downturn in 2023 and a fairly weak housing market, mirroring the very weak economic growth we're going to see for the next 3 or 4 years. So if you're a buy-to-let investor, there may be no harm in waiting a couple of years to see what happens to prices, because there's almost no chance that prices will rise next year, and there's a very strong chance that it will fall quite a lot. I hope you found this video useful. If you do, please give it a thumbs up and subscribe to Economics Help. If you have any comments or questions, feel free to leave a comment. I may use it to make a future video. Okay, thanks a lot. Bye.